The viewers to this wealth creation study presentation, and I'm really proud, and it's a day of celebration for me, not only for the completion of 25th wealth creation study, but just the completion of it, because it is a 3 months of continuous effort, and that to 25th time. I'm really surprised that I've gone in for 25 years of this study, but I mean, it's just not for the sake of doing it every year. It is actually source of learning. And the best thing is that equity markets are, I mean, you never end up learning everything. Every day surprises you. Every book you read, every interaction you see with the Buffets of the world or any new winners, there is so much to learn. Every time you think that this is such a simple thing I didn't see. So equity markets and the learning about them is always evolving. The economy is changing. The world economy is changing. The learnings about what creates value are changing. The parameters are changing. The interest rate cycles are changing. The conventional economics are changing, and I mean everything is changing. And in that changing world, uh, there is a you have to do investing, and that too successfully over a period of time. So it's a very complex world, and and you have to find a way to beat the markets and make your money. So in this competitive kind of landscape, we thought, what is the best way? So 4 years back, we wrote QGLP as our best way to pick stocks, and then we were wondering, I mean, like everybody used to ask the analysts, the junior guys, the guys from outside, the customers, and a lot of friends, how do you do your QGLP? And then we said, let's in 25th study, having done the studies about the quality of business, quality of management, growth, longevity, even valuation, we have done all sorts of studies. And then we said, now time has come to write a checklist. How exactly we process the we how do we conduct the checklist or questions we ask and cover the QGLP process broadly. It can never be all comprehensive, but still we have tried to bring 25 questions with 25 frameworks. Both of these two, they intertwine, and they give us insights into quality, growth, longevity, and price and margin of safety of the companies. So this is the effort at this point of time. The study is presented in two parts, but before that, let me ask you a small quiz. How many times has Infosys multiplied its profits in the last 25 years? So this is a very simple question, and this is the ultimate growth stock from India, and which has changed the landscape of IT industry, and it has been a bellwether for many years. Recently, it had lost that status, but again, I think they're coming back. So let's see how Infosys has done last 25 years. Infosys profit in 1995 was 13 crores. In 2020, exactly 25 years henceforth, its profit is 16,450 crores and is still growing quite well. This is 1,256 times at a CAGR of 33%. When you say 33% CAGR, that doesn't seem to be that big, but 33% CAGR over 25 years. 33% is still not that big, but 25 years of 33% is staggering 1,256 times. I asked somebody, what would be the percentage profit of 95 over 2020? I don't know even whether anybody can answer that precisely, but it's less than 0.1%. I mean, this just opened my mind. In 25 years, what can happen? Nobody can visualize. It's unimaginable. What a successful company can do in 25 years is completely unbelievable. I mean, this company is, of course, the best of the best, but it could be 0.5% or 1% or 2% at best of the current profits for any successful companies. So as the first conclusion of the study is, time is a friend of good companies and an enemy of bad companies. In 25 years, successful companies grow to unbelievably unimaginable levels. I mean, like 100x, 200x, 400x, we'll see all the list here. So studying 25 years is both interesting and exciting and very insightful, because markets are for very long term. I mean, we might say that today's P multiples are high, low, and we might be having a very short term view of 3 years, 5 years, 1 year, 1 quarter, whatever, depending on my profile as an investor or trader. But markets are for very long term. So at times market has confidence for 25 years, and at times market has confidence for just about not even for last 5 years. So that's the mood of the market. But studying 25 years what has happened, and I have lived this 25 years as an analyst, as an investor, as a investment consultant. I mean, every aspect of it we have seen it very closely every day, and we have traded, and that it's been very, very interesting. So let's see how the country has moved. You see I mean, the backdrop in which this entire thing has happened is GDP. Indian GDP in nominal terms have grown at 13% compounded for last 25 years. It was about 10 lakh crores in 1995, and it became in 2019 203 lakh crores, and in 2021 this will be more like again around 190 or 195, very unusual year. But every year you see without fail that it's a nice exponential chart on the base of 10 lakhs in 1995. And I think next 25 years should not be very different. And I think maybe 13 might go to 12 or 11, or maybe it might surprise us with 13% compounded. But the chart is going to be upward sloping the way we are seeing it here. Market cap has equally grown at the same pace at about 14% compounded in last 25 years. So this is the backdrop in which we are talking about the next 25 years, because at this level, on a broader level, these things do happen. I mean, you don't find much of break. I mean, COVID has been a blip for 2021, but otherwise you'll not see major break in the growth of GDP and growth of the markets. But the markets could be volatile, like between 2020 and 2021, we saw in just 2 months, it slumped by almost 40%. So those quotational losses can happen, but one should have faith that as we go along, these things will even it out. So the study is in 2 parts, wealth creation findings and the theme of checklist. So what are the findings? The concept of wealth creation is a process by which an entrepreneur enhances the market value of capital entrusted to it by its shareholders, or the profit retained by the company. Net wealth created is change in the market cap over a study period between 95 to 2020, adjusted for corporate profit actions like equity dilution and share buybacks. And the study methods, initially we thought, how do we do it? Should we do it differently? Then we said there's no point in trying to find any new method or new categories, but let's continue with our 5-year ruling, what we have done for 24 years. Let's repeat it, except for 5 years, let's do it for 25 years. And the moment we changed it 25 years, everything changed. Everything looks so different and yet so familiar. So one of the things was, how do we, I mean, those companies in 1990, I mean, right now we're talking about 200 lakh crore market or 180 lakh crore market. And at that point of time, market was just about 4 lakh crores. So the largest company was more like 10-12,000 crores. And so it is very difficult to figure out in 1995 what was a big company and what are significant companies. So we decided to confine ourselves to all the companies of BSE 500 in 1995. So so then we said, what are the fastest wealth creating companies in 25 years? What are the biggest wealth creating companies in? So we said, first, let's figure out 100 fastest wealth creating companies, and we said the first condition is that it should have beaten the index, and that's where we got just about 100 companies. And you imagine, out of 500 companies, only 100 companies beat the index. And then within those 100 companies, we said, let's find out the biggest wealth creating companies. And then third was the consistent wealth creating companies, where we found a new method of doing it. And we said the companies in every 3 years, I think maybe I'll talk to you when I come to that category. And then fourth is combining all the three, let's find all round wealth creators, the fastest, the biggest, and the consistent wealth creators, all the 3 ranks added together, and the smallest rank of the all 3 becomes the all round wealth creators. Let's see how they stack up. So the biggest, fastest wealth creators is Infosys at 30% compounded in price terms, multiple 688 times in 25 years. And profit grew at about 33% compounded during the period, but because of some dilutions, it became not dilution, but market P multiple decline between 95 and 2007, 2020 got the P multiple in 1995 was 26 and 2020 it was 17. So that gave a bit of difference between PAT growth versus price growth. Typically it is G is equal to R. So that was the thing. And just imagine in 1995, total market cap of Infosys was 345 crores. Humble 345 crores. I think every 5 minutes now market cap fluctuates by 345 crores. And in March 20, when the markets were depressed, it was about 2,72,000 crores market cap. Means entire thing is created post 95. So whatever could have been purchase price, 345 or 645 or 1,000, it wouldn't have mattered. Everything was created after that. And now it is above 5 lakh crores. I think today it must have closed at 515, 520,000 crores of the market cap. So that's the power of Infosys in last 25 years. Pidilite has been every name surprises. I was knowing about Infosys, but I didn't know about Pidilite, that it is a 25% compounded 258 times. I knew it's a wonderful company, but I didn't know that it has done so well in last 5 years, and it has become darling of the market. PAT grew at 20%, but the stock price grew at 25% compounded, and the P multiple went from 20 to 60. I have not seen this amazing kind of re-rating, and it has happened on the back of changing the ROE from 13% to 26%. I mean, some of the data point you might not see it on the screen, but it is there in the full report. Eicher Motors, which I have been kind of personally benefited out of this. The company did 25% compounded, 255 times, and it was a 103 crore company in 95. And then it went to become 85,000 crores. In March, it was 35,000 crores. Now it must be more like 65, 70,000 crores. Sri Cement, I think this was one of the biggest surprise to my mind. See, when you do 25 years, having lived it, yet it's very surprising. Sri Cement at 25% compounded, 19% profit growth, and from 182 crores to 63,000 or 70,000 crores now, kind of a market cap. This is absolutely stunning, and salute to the company for what they have achieved. Berger Paints, again, coming from nowhere. Berger Paints was a literally kind of a I would say, unknown company at 12p, now trading at about 75p, and earnings have grown at about 20%. So all of it are fantastic achievements. I mean, one, of course, they've done well at their own PAT growth, their achievement, and the consistency, and salute by the market in terms of re-rating. And 9 out of 10 market cap of less than 5. Just look at the size of the company in 95. They were all around 500 crores market cap, which is about 0.1% of then total market cap, about 4 lakh crores. So if you are at 400 crores, it is about 0.1%. So they were literally insignificant companies in terms of size at that point of time. So I would say for very fast wealth creating for long term also, you need to have a company which is of reasonably small in size. But they were not that small, in the sense that 500 crores then was a mid-sized company. Second, the biggest wealth creating. I mean, this is the most honorable companies, and they have done really remarkable job. Reliance Industries at 16% compounded, 25-year CAGR of 16% PAT growth. So both of them have been aligned, and at that point of it was humble 12,000. 12,000 crores is almost amongst the top 2-3 kind of a market cap company. Then has I think it was third or fourth largest market cap company in 1995, has become in March, in depressed kind of situation, it was 7,05,000 crores, and now it literally doubled in this last 12 months. So elephants can dance, and Reliance is the ultimate proof. Unilever, again, from 8,000 crores to 5 lakh crores at 16% compounded. So Lever has done as well as Reliance in this period. And then third is Infosys and SDFC, mother of all the wealth creating machines, 2,000 crores to 2,82,000 crores, then at 22% CAGR in terms of profit growth and 19% for the price. So Kotak Mahindra Bank, so they're all who's who, ITC, Asian Paints, Nestle, Bajaj Finance. I mean, this is a new kid in the block. It was 239 crores company becoming like 2-3 lakh crores now, and at about 23% compounded. So this is a staggering kind of money-making machine. And L&T, I mean, this is unassuming the way infra companies have been hit hard, but it has managed against all the adversity in recent times from 6,000 crores to 120,000 crores now. Then we have the most consistent wealth creating, because one is that you can create wealth of front loaded, in the sense in 25 years, first 10 years you grow like mad, and then you slow down big time, because you cannot keep growing at 30-40% for a very long time. Typically, when the companies are small and at early stage, either it is advent of new business section, or the company itself is a small to start with, or it could be combined that in a new business kind of environment, all the companies, even leader companies, are small. So generally consistency is there for some time, and then it gives way to the underperformance. Or you have a back-ended in 25 years study, maybe for first 15 years you don't do well, and on the back-ended 10 years you do very well. But so to call it consistent, what we said, for every 3 years in 25-year period, 3-year rolling, we will look at 23 observations in 25 years, and in how many periods it has beaten the underlying index. So in the first observation period, say 95, 96, 97, if the index has done 12%, has the company beaten that? So like that, we have done for 23 periods, and here we find that Kotak Mahindra is the most consistent wealth creating company at about 21 out of 23 times. This is staggering. And I don't know, there is something to do with the private sector banks and value migration possibility. HDFC Bank didn't participate here, but if HDFC Bank had participated, because it got listed after 6 months, it would have done, I think, a bit better than Kotak Mahindra Bank. I think 23 out of 23 times that would have consistent. So Kotak Mahindra is the most consistent company here. Berger Paints, HGFC, Pidilite, Shree Cement, Honeywell Auto, Motherson Sumi, Asian Paints, Dabur. So they're all very consistent companies. Like Sun Pharma is 18 out of 23 times. Here we find that 8 out of 10 are consumer facing companies. So consumer companies have been predominant here, because consumer 55-60% of GDP goes in consumer. They are very predictable, and typically regulations around consumer companies are far easier compared to B2B, where the other party squeezes the producing company in terms of profitability. So B2B has been less of the kind of wealth creators. 2/3 have been B2C and 1/3 has been B2B. All-round wealth creators, I mean, fastest, biggest, and most consistent. When you do all the three, then you get the total ranks of the wealth creating companies as all-round wealth creators. Kotak Mahindra again scores the best. Pidilite as a second, and very shortly we'll talk to Bharat Puri, and he has consented to be with us for some time to answer our checklist on Pidilite, and be with us and throw light on the Pidilite's business models and things like that. So he'll be there after half an hour. So Pidilite is second best, Asian Paint is third. So all of them, they are very good. One quirk in this thing is the Infosys. Infosys was is the fastest wealth creator, biggest wealth creator, third biggest wealth creator. But in consistency, it's about 61 number. Out of 100, it is 61st. So that has kind of hurt. And a lot of people ended up selling up during that particular period. So the total rank is far higher, and that's why it has not made it into top 10. But that seems to be something which is inconsistent, and it is coming back in terms of on the consistency score. In terms of consumer, in terms of sectors which have done well, consumer and retail have done 28% of 46 lakh crores, which has been 43 lakh crores, which has been total wealth created in this period by these 500 companies. So total consumer is 28%. Oil and gas, mainly led by Reliance, is about 7 lakh crores. NBFCs, this is a completely new category, has created 9% of the wealth. Pharma and healthcare, 8%. IT is 7%. IT actually, on the whole, because IT had just about started getting listed, and only Infosys and few companies were listed. After that, there was a barrage of listings, and actually, the total wealth created by IT is by far, I think, after consumer, it is the second largest, if you include the other companies listed after 95. But for the companies which are listed in 95, it is 7% of the wealth created, and the private sector bank is another 5%, paints another 5%, and autos 5%. Top 5 sectors account for 2/3 of the wealth created. So it's a wealth creation is very, very concentrated among the sectors and as well as companies. The big ones who missed the list, I mean, because the cutoff was 9% minimum wealth creation over 25 years average. So guess the market cap in 95, the most valued company in 1995 is State Authority of India Limited. Can you believe this? In 1995, State Authority at about 14,000 crores market cap was #1 company. MTNL was third largest wealth creating company, the largest market cap company in MTNL. Tata Steel, HPCL, Tata Motors, Tata Com, Colgate Palmolive, Castrol, Grasim, Tata Chemicals, ACC, Vale, I mean, you name it, Century Textile. That was the kind of I mean, market leader for many, many decades, I would say, Century Textile. So they've all left, I mean, over that period, they have, because of various reasons, those companies have lost their way in terms of pace of wealth creation. And some of the companies have died, I mean, literally become zero, where you see 13% minus for MTNL in 25 years compounded, or State Authority -2%. We are talking about 70, 80, 90% erosion, or maybe even plus 90% erosion in the companies or kind of thing. So some more data points about the 25-year studies. One is that in 1995, the total market cap was 3,08,000 crores for all the companies listed. The base companies were 3 lakh. So this is the top 500 companies. Otherwise, total market cap was 4 lakh crores. So 3 lakh crores. And now the same 3 lakh crore company, same companies have a market cap of about 112 lakh crores. Sorry, the total market cap today is 112 lakh crores, and in 1995, the company was 3,08,000 crores. In 2000, in next 5 years, it became 7.5 lakh crores. But new listings, mainly led by tech companies, it was 2.5 lakh crores. So it became 66-34, 66% for the existing company and 34% for new companies. In 2005, it became 50% and 50%. 2010, so after 2005, the listings before 95 have become stabilized at about 48-50%. I'm very surprised by this. I thought 66, 50, 45, 40, like that it will happen. But somehow it is stabilized at 50%. Maybe the new companies are not, significant new companies are not getting listed after 2005. So, or maybe thanks to Reliance and Infosys kind of companies and Lever, the 50% market share for companies listed before 95 is not disturbed at all. The same is the ratio in profit. If you see, earlier in 2005, profit share was about 58%, market cap ratio was 66%, and now profit ratio is 53% and market cap ratio is more like 48%. So this 50% roughly of the profit and market cap, that ratio is maintained between base company listed before 95 and companies listed after 95. The most profitable companies in 25 years measured by average ROE is Lever at 68% compounded for 25 years, Nestle 62%, Colgate Palmolive 61%, Castrol 56%, Hero MotoCorp 41%. So these have been wonderful companies, and these companies are going to continue to remain as profitable as they are, and probably they might become even more profitable. But some of the names which might surprise you in terms of their ability to have had such consistent high profits for such a long period. And some of the companies here like Infosys, I would say Infosys and even Hero MotoCorp and I think so these companies have a different business profitability, and balance sheet profitability. These are all balance sheet profitability, and they're sitting on very large portion of treasury, which is depressing the profitability. So inherent, their own profitability is much higher. The 25 fastest PAT growth companies are Infosys, Vedanta. Vedanta has grown at 29%. This is again a surprise entry, but that is more because of acquisitions, and they have paid the price and dilutions. So the wealth creation speed is not there, but per se they have been able to grow the profit in a much bigger way. Motherson Sumi, Bata India. Bata India is a complete turnaround from nothing. It has come to grow at about 26% compounded. Bajaj Finance, Emphasis, Sun Pharma, Aisha. So all the companies which are the fastest in their profit growth. Then 25 highest cumulative PAT in 25 years, which are the companies which really amassed all the total profit. So this is the addition of all the 25 years profit. Reliance, 3,78,000 crores. That's quite something. SBI, 172,000 crores. Infosys, 152,000 crores. ITC, 120,000 crores. So they have been huge money machine in last 25 years. So 25 highest cumulative dividend companies, the companies which are really rewarded here comes the shareholder friendliness. ITC 70,000 crores, Infosys 63,000 crores. If they include your buyback, I think it will be even bigger than that. So Infosys is not only fastest, they're also the biggest dividend paying company so far. Hindustan Zinc, this is a new, this is surprising to me that 50,000 crores have been given by way of dividend by Hindustan Zinc alone. And it is as big as Hindustan Unilever, which has given 50,000 crores. Reliance Industry, 45,000 crores. So now the list runs of big dividend paying companies. And now with the collapse of treasury yield of below 5%, I think the payout ratios will open up more, and now dividend distribution tax has also gone away at a company level. I think board members will be very kind to increase the payouts to the shareholders. So another thing we have seen is that in last 25 years, this is a big thing. If you see the how the corporate sector profitability has moved in last 8 years or in last 25 years. So earlier, and so we have combined all the companies into 37 industry groups. Here we have seen that sector profitability above 13% and below 13%, and for every year. And here we have found that out into 95, the corporate sector was very healthy in terms of profitability, and 26 out of 37 were earning more than 13%, and 11 were earning less than 13%. And it kept on going down. In 2002, it became 8 and 29. 8 were doing well, and 29 were not doing well. Then the bull run started, and in 2008-9, in economic boom, at height of boom in 2007, it became again 29 above 13% and 8 as a lower than 13%. And then from there, the decline started. And now in 2020, we have 10 industry sectors doing above 13% and 27 below 13%. And I think 21 will be worse than this. So I think we have hit the bottom in terms of corporate profitability. And this is further reflected by the actual corporate profitability numbers, where after 8 years of stagnation between 95 and 2002, when it hit at bottom of 1.7, it went up to as high as 5.7, and now it has come down to 2.3. I'm quite sure 2020-21 will be worse than this, and from there, hopefully the recovery starts. Or if by chance it stagnates here at 2.5%, I think it will be very difficult for us to make money. But my sense is it's like a pendulum. I mean, it has swung one side at the extreme, and now I think there's an opportunity for it to swing other side. And at least what I hear, and at least the expectations which are being built in the market, it looks like corporate profit GDP is to swing on the other side. And this is reflected again in the EPS growth of the, this is all interrelated in terms of wellness of the corporate profitability at a broad level, and then corporate profit GDP. And here finally at Sensex level, Sensex EPS also stagnated between 95 to 2002, and then it took off from 2003, from 235 to 36 to go to as high as 833, almost like 4x in 4 years. or 5 years. And from there, it again started slowly growing. And now at about 1500, it is stagnating for the last 3-4 years. GSEC yield, which is a discount rate, has come down from double digit in the early 90s, late 90s, 95, 97, to as low as 5% or below 5%. And then again, it is hovering at about 6% now. The worldwide, I mean, now since the marketplace is far more global, the importance of global interest rates are also relevant, because a lot of investors incrementally are coming from the global situation, and their interest rates have fallen to literally 1%. So that is also having impact in the marketplace through the valuation is all-time high. So the earnings have not been great in last 4-5 years, and valuations are looking a little stretched for the given earnings. And though a long-term average has been about 18, and that's where I think market bottomed out in March. In March, it actually touched the average, and now it is again back to slightly demanding valuation, probably because of massive liquidity and low valuations, and the low interest rates. Market cap to GDP close to all-time high at about 100. It's all reflection of the current valuation and what happened in 2008. Now the market cap to GDP is again touching 100 in terms of our nominal GDP, and so it's from here onwards, I would think that a market at best will track the nominal GDP growth rate it is very exciting, because after the correction in March, it has all traced back very quickly. But from here onwards, incrementally on year basis, I would think that it will track the GDP growth at an index level. Of course, nothing happens at 12%, 13%. Again, it can do 25% and then correct. But I would say from here onwards, market cap to GDP growth will track GDP growth will track the market cap growth. So we tried to do 25 stocks for next 25 years, seeing our experience of all the data crunching. We said, what are the observations of last 25 years for top 25 stocks? Almost all the companies were small to mid-size in the base year in 1995. Were consumer facing, bestowing them a secular business model, were very profitable. Average base ROE was a robust 17%, and grew to emerge as the market leaders among the top 3 in their respective segments. Had the management with a high integrity and competence. That was a kind of broad framework of the companies in 1995. And so deriving from this and some more filters of value migration and potential of the management, potential of the company, we arrived at, so how did we arrive in the current context? Start with 150 mid-sized companies from 101 to 250, and then mainly selected consumer-facing companies which are profitable. And then we said assess the business potential and management potential, because what you are buying in next 25 years is not the current valuation or current profits. What you are buying, because bulk of the profits and sales and has not happened. I mean, it has done less than 1% of what it could be. I mean, what you are seeing is the tip of the iceberg. The companies which are going to be successful in next 25 years are going to be at least 100x on 50 to 100x in next 25 years. So we have to see that how the tip is looking at this juncture. So the business potential and managerial potential is very important in terms of what they can do, and we have preferred the market leaders because and value migration beneficiary. So market leaders, why? Because the last to die in that particular business segment will be market leaders. And value migration also is a slow process of transferring from old business model to new business model, and typically it lasts for decades actually. So that gives you an opportunity for the emerging leader to become very large as a value migration takes place. And for financials, mainly prefer large caps because being risky business, leverage business, you need some kind of stability. The large will become larger, and hence we have picked up some large caps beyond less than 101 ranks. Well, and this entire exercise, what we have done is completely valuation agnostic, and in the very long run, valuations matter less. So this is how our chosen list looks. They look pretty shiny right now. I'm quite sure that this is only to explain the concept, and it is not should not be used as development for implementation of any investment strategy. It is not investment advice to any party, but this is how, if you run some of the screeners or some thought process, I think this is how the list will look. So now thematic for this study, QGLP checklist, 25 questions, 25 frameworks. So the way we have gone about is that how actually we practice QGLP, and there are not too many checklists for the investment process. We have one by the earliest one we know is that of Scuttlebutt by Phil Fisher, which was done in 1958, and after that Michael Chern checklist, the investment checklist book. But beyond that, I have not seen many checklists which is very nicely put up to help the investors. But this checklist is bit of restrictive in the sense that it is not fit for say if you are a deep value investor, then I think checklist should be somewhat different. But this is a checklist only for QGLP stocks, and hence we have called it QGLP checklist. Let's look at it how it has moved. So checklist is required because equity investing is very dynamic with a lot of variables and very complex. And a checklist ensures that all the key variables are checked to see whether they are in order. Because what happens is once you are bought and then you realize that this particular thing you ignored or didn't bother to go through. So instead of bothering it a little later, before buying only you complete your homework. And a checklist should ideally also help investors to arrive at value of stocks to determine value price gap. See, what happens is that when you're going through all the processes and you are well versed with the process, the process itself gives you good feel about the value, because value is not determined by just one factor. There are various things. I mean, like competitive situation can be very, very strong, or the nature of the competition should be such that it is such a huge leader that it has 80% market share. So everybody takes in. I mean, there are 4 guys with a 25% each. That's a different kind of competition. But if somebody is very dominant, then it is a very different kind of competition. Or in a 4 guys who are very dominant, 5th guy comes and attacks the industry. That's a very different kind of competition. So I think you will come to know about the company while going through each and every question. To understand an aggregate of all the questions will allow the investor or investigator to understand the underlying value, which is the basic objective of to become. See, price is known to everybody, but value nobody knows, and this is the process to find value of the company in a very systematic fashion. Few pointers to the current checklist is QGLP itself. I mean, the very purpose is that we have to find quality, growth, longevity at reasonable price, so the checklist is designed accordingly. Still, it should help a wider audience who picks a stock based on company's business and financial fundamentals. This checklist is work in progress, and this is the first attempt to write this checklist. But over a period of time, as we learn more and more, this checklist will be tightened. So what we look for? What we look for is QGLP companies which are compounding machines. Basically, we want compounders in the next 3, 5, 10, 15 years. As longer the better, but the companies which have the potential to compound from the current purchase prices. So since the compounding is such an important thing, I mean, we have seen 33 years for 25, 33% at 25 years. So what is important is, of course, 33 is very important. The height of the pace of growth is very important, but more important is the number of years it has done. Just look at it. At 25% for 10 years, it is 9.3 times or about 10 times. But if you triple the number of years, you go from 10 years to 30 years, the end result is not 3x, it is 87x. That's the power of compounding, and that to longevity compounding. So you must always try to find something which is I mean, going to pick up pace in the back end rather than front end. So what happens is that when you grow, at a rapid pace after 10 years, 15 years, 20 years, 25 years. That's what makes it a huge company. Like Reliance. Reliance has been growing at 20%, 16, 17% for many, many years. I think, I don't know about from 76, 77, it got listed. It must have grown at 20, 25% for first 25 years. And in last 15, 20 years, it has grown slower because of the size. But just that it is a sheer longevity and consistency of growth. That is what has made it such a large company. So power of compounding is very powerful, and we are looking for compounding machines. And what are the factors of QGLP? Quality of business multiplied by top quality business, top quality management. We are looking for top quality business. So our questioning will be always to figure out top quality business and consistent businesses which have demonstrated their profitability. And second is a management, because ultimately the nature of business could be great, but you also need fantastic management to allow the business, to make, you have a fantastic horse, but you also need fantastic rider. So just the brilliant horse and useless rider is not going to take you anywhere. So the combination of rider and management and the business is very important. And then growth in the earnings. Some of the, again, growth in the earnings is function of volume, price, mix, operational, financial leverage. Those things are there, but ultimately growth in the earnings can be because of external factors and internal factors. And then we have the longevity of quality and growth. And these are three value buckets, and then the price. How do we assess all the four factors is the way we have designed the questions. So what is the QGLP checklist? So we have put in 5 boxes: business, growth, management, price, and risk. This is how we have put the buckets. So we are looking at the business, all the related questions with businesses, growth in the business, management competency and passion and integrity, and then finally the price. And before that, before you go to buy, look at if any of the things don't work. So checking the risk related matters. So what is the business checklist? So first of the list is what is the history. I mean, when we will talk to Bharat and we'll show how exactly. But the most important thing in investing, what I've learned, and Buffett said in his 2007 annual letter, that the 4 things they see, but the first of the 4 is, do we understand? Do we understand the business? So let's start with the history of the company and the management. So just when you meet the company first time, start asking what's the company's business, what is the business infrastructure, what kind of number of plants, branches, depots, retail outlets, what is the infrastructure, local, global, what's the age of the company. I mean, some of the companies could be 3 years, 4 years. In private equity, we get to see 2 years old company, 3 years old company, companies which have business plans, barely anything on the ground. And then who's the owner of the company and how is his competence? Because companies are built by the owners, though run by professionals, but initially it is always built all over the world by the owner of the company. So how good he is, how competent he is, and from where, what is his educational background, how driven he is, what kind of, is he first generation, is he second generation, is he very competent, has he got adequate experience, and what is the composition of the board, is it broad based, is the company owner managed or professionally managed, and how is the broad financial and stock market performance, particularly financial performance in last 3, 4, 5 years if the data is available. So this is generally just to get introduced with the company. Then second question is the company's business model understandable? See, I mean, when you look at, when you try to understand the company, finally you try to figure out, can you describe the company in a minute, in 2 minutes? If you cannot, it means that you have not understood the company. And Buffett was asked, Buffett said, I don't understand a lot of businesses and that's why I don't invest in a lot of companies. So somebody said, what is that you cannot understand with so many people around you, best of the people in the world? So he said, I should be able to visualize how this company's profit, sales, and other things will be there 10, 15, 20 years out into the future, because I'm not buying for 1 or 2 years. I'm buying for many, many years. So what is important is to understand the business model and understand you should be able to kind of feel the near future and mid-term future, or maybe even long-term future of the company. And is it a product or service company? because the economy worldwide has gone two-thirds in service economy, and manufacturing companies are a smaller segment of the world GDP. So is it because the economics of product and services are very different? Services are generally non-tradable, whereas product companies are very global in character. Domestic company or global company. One of the things which we are seeing is that the Indian companies, the whose journey started more, I mean, this entire post 92, this journey started where companies were very, very inward looking and not so much externally looking. But now with the advent of IT, pharma and all, we are seeing that India is giving birth to a lot of global companies. So are they hybrid? Are they pure Indian company, pure global company, or hybrid companies? So it is very important to see what is the, and the moment it is global company, the size of opportunity just explodes. So is it a global company or local company? Does it have monoline or diversified businesses? Is it about one business or it is about multiple businesses? Is it diversified, and what is the business mix? Is the business secular or secular? This is very important. Is the business secular? I mean, typically it's a consumer facing and with little fluctuation like pharma, FMCG, staples, or it is more of a large ticket B2B, or it is cyclical in character, like say truck. I mean, in automotive, like two-wheelers are very consumer facing with 50, 60,000 rupees per ticket size. But a truck is a business requirement. And 5 lakhs, 7 lakhs, 10 lakhs is a single truck cost. And this is funded and this is part of the business cycle. So that gives a cyclicality to the business model. So is it secular or cyclical? Markets typically prefer secular businesses because you don't know how deeply a cycle can correct. Somebody was telling me that truck sales today in this year is going to be like lowest in 17 years. I mean, what trucks were produced in 2003-4 is going to be produced in this year. So this is the kind of severeness of the cycles. So markets don't like any kind of uncertainty. Market likes the predictability of it. And is it a B2B, B2C, or B2G? I mean, business very predominantly looking at the government, serving to the government. Is it serving to the customers, businesses, or it is serving to the customers? And markets are very, very friendly about consumer because the consumer behavior is very well known. Business, they have the bargaining power and they can behave very differently. They can have it in-house also. And governments, you know their finances and budgetary allocations and all, uncertainty of the government finances. So the markets tend to give lowest valuation to third category, second best to the B2B, and the highest valuation to B2C. And what is the value chain analysis? Then finally, to understand the business, you have to break into component and understand the entire cycle of how business happens, how order is being generated, how raw material is being bought, how the product is assembled or produced, and then how it is being sold, and how, and then it is being sold, data is being collected, and the entire cycle of business happens. So that understanding value chain at every stage, the supply chain before the production, and after the production and sales has to be taken care of. Chair is going down. So understanding business is extremely important, and this is, I mean, once you understood the business, and every business has that 90% rule. What I try to understand, I keep probing at the beginning of the interrogation. We try to keep figuring out, because every business is simple in the minds of the people who are doing it. It is complex in the minds of the people who are observing from outside. So it is the job of the promoter or the people who are from the company to make us understand in a very simple way how money is made. Finally, businesses are input-output model. There has to be a simple way of capital input and the output. He should be able to explain how he makes money. Then one of the things is, I mean, this is something which is very close to my heart and which we learned in 2008 study, Great, Good, Gruesome, and Emergence. The fundamental thing is about the profits. I mean, we know market cap tracks the profit and profit growth. So here, the Great, Good, Gruesome, this framework was told by Buffett in 2007 annual report. And here he talks about three kinds of businesses. terrific businesses, great businesses, good businesses, and gruesome businesses. And typically 20% of the businesses in any market are good and great, and 80% are gruesome. Now, what is a good business? Good business is a business which earns more than cost of equity, say about 13%. But 13 to 20%. And these businesses are good businesses, but if you want to double the profit, you have to bring a lot of capital. Say, if you are earning 13 rupees, and if you want to make it to 26, you have to bring another 100 rupees by way of capital. So it is a capital, but since it is above free cost of capital, it creates value, but you need a lot of capital to engender growth. Typically, banks and a lot of these commodity companies are in this particular range. So they are good businesses. What are great businesses? Great businesses are businesses which first year it earns 20%, then 25, 30, 40, 50, and finally you don't require any capital. So that's what you see. Lever, Pidilite, Asian Paints, Castrol, those are the businesses which have been great businesses, and they have been a money-making machine without requiring much capital. And then third is the gruesome businesses which are below cost of capital, below 10% or 8%. They do make profit, but they require a lot of capital to make profit. So they are called gruesome businesses. And finally, if you have 6% return on capital or 7% return on capital, that is what is going to be your end result in the years ahead. So you have to be very careful what kind of business you are bringing. And if you are bringing very high return on capital businesses, that is what exactly is going to be your end result in terms of return. So economics are very clear in the long run. Bad businesses will take us to difficult places, and good businesses are going to give us good return. Then the moment we see the profits, and then we realize that it is a good business or great business. So the moment I see that profits ROE is about, I typically run 15-year data on the screen. And there, the moment we see that it is a good business, the next question is the terms of trade favorable? Is the cash flow healthy? Because companies with favorable what you need to see is that is the profit being translated into cash flow? Because ultimately you can do nothing with the profit if the profit is not related with the cash flow. And that you come to know when the debtors and creditors ratio is good, or basically is it getting locked up in in the working capital. So typically a lot of companies, they make profit, but you can also increase the profit by increasing the debtors or inventories. So that's what we have to keep checking, whether it is resulting in a high cash flow. Then what is the cost and margin structure? This is a common size analysis which we keep doing for our companies. The moment I see that everything is fine, then we immediately go to see the common size ratio. And common size ratio, for if you do it for 15 years, you can literally, this is the history of the company on the screen right in front of you. So what does common size ratio tell you? This is a example of Bata India common size ratio for last from 2005 to 20. And here, if you see that this is the analysis from 2005 to 2010, where if you see the raw material price is more or less 46%, but employee cost in 2005 was 25%, and in 2010 it was 13%, and EBITDA margin was 2.7%, which went to 13%, and net profit, which was barely there, has shot up to more like 9-10%. So the change in the employee cost, because of the labor union were very strong then, and they had a settlement, and the company was revived because of one fundamental change, the labor cost, and the rest all is a story to become a blue chip company. So I think these are kind of things which common size analysis tell you about, and then it helps you. One is to do intra-company comparison, and you can ask questions from the management whether what is leading to this particular change. Is there raw material prices becoming uncompetitive, or is there a labor productivity change, or have you gone about outsourcing? So a lot of these ratios tell you what to ask from the management. Then how is the DuPont analysis of the company? So one of the things we do is that this is all related to business. We are still trying to understand business. Here we are looking at what I have seen generally is that people are focused about margin. I mean, they talk about the PAT margin, nobody bothers too much about what is the ROE and what are the components, what makes it the ROE high or low. So here is the very simple three components of broad three components of DuPont: PAT to sales, sales to assets, and assets to net worth. It's available anywhere. And here, the moment you go from margin to the asset turnover, you look at the small thing below. Hindustan Lever has 17% net margin, and Divi's Lab has 26% net margin. Who is more profitable? Anybody will say that Divi's Lab is more profitable. And that's the general feeling. But no, Divi's Lab has 0.8 as asset turnover. Both of them are unleveraged largely. And Lever has 3.84 times. And hence ROE is 84%. Whereas the Divi's Labs, though very profitable, 26% net margin is insane. But it is only 20%. It is 4x more profitable than Divi's Lab. So this is very important to understand who is more profitable company. And what is the source of profitability? Then we have what is the competitive. This is the mother of all in analysis. What is the competitive landscape and what is the role of the regulation? Here, Michael Porter's 5 forces is the way to go. Even the analysis of 5 forces itself is evolving. So because competition, one thing which defines the intensity of competition and the shape of competition decides the profitability of the industry. If you, I keep telling people that a vada pav guy sitting in one street can make money because he has no competition. But an airline, which is such a complex business, but if the competition is intense, he cannot make money. So that's the nature of competition. You have to figure out how competition is shaping. Is it healthy or unhealthy? So what is the type of competition in the sector? Perfect competition, monopoly, oligopoly, whatever. So you have to look at it. And who are the company's key competitors? Is the company's products are globally tradable or non-tradable? This is another thing. I mean, if the company's product is tradable, I mean, like most of the products are, say, like steel is tradable, but cement is not tradable. Though it's an industrial product, but so cheap that the logistic cost is very high, is non-tradable. Then you look at the 5 forces. Is the threat of new entrants are there? I mean, in some businesses, the new entrants can never enter because, say, like liquor business or somehow the existing entrepreneurs have created, like now auto companies like two-wheeler or even four-wheelers. The threat of new entrants are very, very low. Then you have threat of substitute products and services. Can this particular concept of two-wheeler, four-wheeler, or paints, or for that matter, telecom, or whatever is the underlying service or product, can it be replaced by something else? And then third, and I think actually the first, is the rivalry amongst the current players. If there is a fight in the house among the players, you are not going to make money in the industry, because if the intensity of the fight is such that one is about to kill to other, definitely the industry profitability goes for a toss. So we have seen in telecom, because of the intense rivalry, the consumer-facing, rapidly growing industry, the asset turnover margin has been restored to 35-40%, but asset turnover has gone from 1.25 to 0.25 and destroyed the entire industry profitability. So intensity of the current rivalry decides the fate of the industry profitability, and then the industry opportunity or the profit pool opportunity is being shared by, again, the customer's bargaining power and the supplier's bargaining power and the incumbents. So basically, one has to understand how competition is with various facets. It's not set for, there's no standard thing. Everywhere you have to really figure out how the competition is happening. The moment I see the ROE for 5-6 years is more than 20-25% with very good terms of trade, there is some magic on. Whether I can understand or not, that's a different thing. But clearly, there is something happening and the competition is allowing the other guy to make money. We have to figure out what are the sources of advantage and how long it is going to continue. So that leads to the next question: what is the sustainable competitive advantage of the company, and what are its sources and how long it can continue? So strength of the company to keep competitors from nibbling away its profit. The moment you make profits, the moment you make 1,000 crores, 2,000 crores profit, or even more than 100 crores in India, I think competition will pile in. I mean, there are enough guys who are watching you, and they would like to compete and take away your profits. Actually, they don't want to take your profit. They themselves want to make money. But if the opportunity is limited, clearly the profit gets shared between a lot of people. So the concept of economic mode, cap and gap, that the competitive advantage period and growth advantage period, this is the study earlier we have done, which demonstrates what is the, how long the competitive advantage period can last. And that is and how long the growth can last. So what happens is that the market see 5, 7 years, 8 years out into the future, and they think that after 10 years or 5 years, the competitive advantage will go away because the competition will come and kill the current profitability. But what happens is that over a period of time, no new entrants are able to come, and the competitive advantage period get prolonging, and that's why what is being appraised 10 years back as the competitive advantage period becomes 25 years, 30 years, 40 years, and valuation keeps rolling. So sources of competitive advantage and moat is strong brand, patents, wide distribution network, switching cost, proximity to raw materials or cost, or cost advantage due to scale. Basically, there are three generic ways of creating competitive advantage: lowest cost, differentiation, and scale. All three in combination. So, but we have to understand from where this magic of high ROE is happening. Now, having understood that this is a very profitable company and it can sustain. I mean, I'm convinced that it can sustain and nobody can disturb the game. Then we come to check how is the growth going to happen. So what is the addressable market opportunity and its key driver? Because no business can grow to sky, but what is the potential size of the market and where the company is operating? So here, some of the frameworks which has worked in a very proprietary fashion also is, one of the things is value migration. I mean, next $1 trillion opportunity for Indian growth strategy, and category winners, winner categories and category winners. So we have, I mean, this is, I mean, you can use many other ways of understanding the growth, but it is important to understand, after understanding the company is good, immediately try to understand how big is the opportunity. So value migrates from outmoded business model to superior business model. So when this happens, what happens is the large bucket of value passes on to the newer players. So the growth goes on for decades, and then underlying business also keeps growing, like telecom from wire to wireless. And now that particular migration is over, all it has become wireless. Literally 90%, 95% has become wireless. So that phase is over. Now from traditional cellular companies, it is going to more IT-driven kind of telecom companies. Then IT from Boston to Bengaluru. And that from $1 billion export in 95, we are doing about $150 billion in current years, and is still growing at 10% on this base. So this is one of the largest value migration in the world. Banks from public sector to private sector, while the banking system itself is growing at 10, 12%, 15%. In last 15 years, the private sector has got a 30-35% market share, and public sector still has 60% market share. So that is going to happen in next 10, 15 years. So this is what the value migration can do in terms of growth. This is about India, the next $1 trillion opportunity. This is a 60, 70-year journey, 60-year journey of India. Literally started in 51 at $22 billion of kind of total GDP. Now we are talking about $3 trillion literally, and every $1 trillion is going to come much faster in next 3, 4 years, 5 years, and that is one of the most exciting opportunity for the exponential growth. What is a doubling of GDP is exponential opportunity for a lot of businesses. So what happens is when the GDP goes from $1,000 to $3,000, typically the basic spend remains static at about $600-700. Then savings and discretionary spend, they grow exponentially by 10x or 4x. So all the businesses catering to those businesses, they are the companies which do very well. So these things, they help you build some kind of a growth model for your underlying companies. What is the company's growth plan and how sustainable is the growth? So, I mean, you have to keep probing till you get a model of growth in your mind. So, we have, one is to understand how profitable is the growth and what growth can do to the company's profitability. There we do CVPM analysis. So cost, volume, price mix, this comes from the cost accounting, but very, very helpful in terms of, in a very generic way, understanding from where, I mean, is it the volume is going to grow? Is the price going to grow? Is the cost going to come down? Or is the mix of the new and old businesses are going to work? So you have to be very clear how exactly this growth model is going to come up and how sustainable is the growth. Is it going to come from new geographies like exports and all? Because a lot of Indian traditional companies are now looking outside India to build the growth in their businesses. And then finally, you have to really figure out, is the growth well funded? I mean, if it is a gruesome, 10-12% kind of ROE company, then the growth capex requirement is very high. If it is very high ROE company, then growth capex requirement could be very minimal. But funding of growth is very important. Management checklist. So here, Phil Fisher says, in evaluating common stock, the management is 90%, industry is 9%, and all other factors are just about 1%. So is the management high on integrity and transparency? What to look for? No sharp practices. And preferably full tax paying company, healthy dividend payout, and a moment of management integrity. What I have seen that when you look at a company, in fact, a lot of companies are introduced to me first hand by the people who swear by the company and the company's management. And that is a very good way to start looking at a company. And after that, the job becomes much, much easier, because because it is very difficult to check the integrity. Somebody is swearing it by saying that this company is of the highest integrity. That is 90% job done. Rest all we can do by table research or talking to the company, looking to the CAM call, and the whole lot of disclosure SEBI is providing for the minority shareholders. So moment of integrity and transparency is very important. Second, is the management competent? Which is actually the first question. Is the management competent? So management competency and management integrity are two axes on which management is being judged. And when management competency and integrity come together, in management competency, I'm also including very important part of the passion and the growth mindset. So if the management competence is high and integrity is also high, that's where the magic of good management happens. And does the management have growth mindset or fixed mindset? See, what happens is that some businesses, managements are very competent. A lot of managements are very competent, but even among the multinationals, whether they have the fixed mindset or growth mindset, those with the growth mindset see failure as a learning opportunity for future success. But with the fixed mindset, they see failure as a risk, and they keep avoiding failure so that they are not able to move forward. So it is very important to see what kind of mindset the managements have. Does the company have the rational capital allocation policy? So, once you start making money, then you can use your cash flow for repaying debt. You can reinvest into the new projects, which become the bigger source of making money. Typically, all the newer companies, that's what they do, and make acquisitions, like we have seen HUL has done Glaxo, or hold cash in balance sheet, which is now has been more recently big thing, and pay dividends and buyback. So very important to see whether there is a good balance between paying out and using it for your own businesses and having a treasury. Does the company have a suitable organization structure and management depth? The two words, the two key words around management depth are professionalism and empowerment. You'll find that many companies are driven by one or two star promoter or top guy who is running the entire environment, and below them you'll find everybody disempowered. So that's the good big company. Company can become multi-acts if the people are empowered, and people are not hired only for doing things, but also for using their brains. So are the people empowered down below? That is what has to be seen. And what is the organizational culture? Organizational culture is decided not by what they say, this is my culture. It is all about what the other stakeholders like customers, dealers, suppliers, more importantly the ex-employees, they have what kind of opinion they have about the company, and those guys, they decide what is the culture of the company. And labor relations, are there too many exits and laborers are dissatisfied? Company more particularly, I have seen in my interviews, the companies, the smaller companies which don't treat their employees, low-down employees or low-paying employees not well, they are the companies which don't go very far. They have to respect individuality, and that is part of the organizational culture. And then does the company has a sound succession plan? If the company is owner managed, yes, most likely the successor will be from within the family. but does the successor have the competence and the level of integrity which the predecessor has? Second is, I mean, professionally managed companies, they impart, if it is successfully managed, the professional managed companies, if the succession is planned well, it is the biggest source of longevity of wealth creation. So the key point to note here is that the succession is from within the company. They grow their own wood for the next generation, or they keep getting the vertically from outside. So again, how the process is being managed in last 1 or 2 times has been very important. We have seen a lot of difficulties because till about 95, 97, India incorporated was very small. Now it is gaining some muscle in terms of global size. And here, the generation which brought us this far are retiring. So the changeover is going to be quite unsettling. And here, succession is going to be very, very important. Do the owners have enough skin in the game? Of course, this is significant promoter holding, and in whatever way it has to be judged, but skin in the game of the management is very important. And pledging of the share, how exactly this has become a new phenomena, but one should see it in its own merit, why they are doing it, and if they have done it, does it entail any kind of danger for the longevity of the current style of management? Then, having seen the business and the management, then the next list is the price checklist. Now here we are coming to more sensitive stuff and important thing. Here, first, I mean, I encourage, or I do myself, I mean, I'm not good at Excel and all, but still I try to mentally or on a piece of paper, has the financial modeling been done with the estimates for at least 3 years. So this is where actually all kinds of sales side guys, they help us in making the revenue model, cost model, P&L statement. But when I do my own estimates of the next 2-3 years of earnings, and that's where my total understanding comes to play. And that's and it is very important, because once I know I built my own data and I put my own most reasonable estimates away from whatever others are saying, I know I would be right. And when I understand the business, I can do my own estimates. And it is very important to understand the value of the company, because outsiders may have not understood and yet put the numbers, but you are the person who is writing the check, and you are going to pay for it. And fancy sums you are paying, 50p, 40p, 30p. So better you know what for you are paying 30 times and how it is going to grow, what is the quality of it. So doing your own numbers is of immense importance. And then once you do the number, you can clearly figure out whether there is a QGL. Is it a QGL stock? Is there quality? Is the quality of business? Is the quality of management? What excites me is the top quality business. And then immediately next thing is, what is the top quality? How is the quality of management? And then third is the growth potential. And fourth is figuring out longevity of both of them. And so while doing all this, we are able to figure out whether all the above are there and whether it is a QGL stock. And let's look at the valuation. And here comes the trying to figure out what should be a reasonable valuation. And if you give a peg, my most favorite ratio is peg, which is trailing 12 months PE and earnings expected to grow in next 2, 3, 5 years, or a payback ratio, market cap divided by next 5 years profit. So typically I try to estimate the profit for next 5 years, which includes the growth also. So that gives me some kind of a value, and the price is already there. So if the stock is available one peg or little more than one peg, if the quality of profit is very good or very, very good, like a 80, 90%, 100% ROE kind of a potential, then I'm willing to pay even 2 peg. So I think beyond 2 peg, I start becoming kind of uncomfortable. But by chance you get less than 1 peg, because stock could be small or it could be mid-sized, and market may not be knowing the story, and that's where you hit upon a massive margin of safety. So massive margin of safety and the value price gap, and that's where you get hit. You have a potential multi-bagger. So margin of safety is the ultimate kind of concept between, and it is the intrinsic value of a stock and its market price, value price gap. And the greater the difference, the better it is for the investor. So if I can get it for half peg, means my payback period is less than 5 years. So that is the first starting point. And basically function of margin of safety. Why one should have margin of safety? In essence, that of rendering the unnecessary and accurate estimate of the future. Nobody can estimate the future, but future unfolds day by day. So there is some estimate of the future, and if you pay very little, in that case, probably uncertainty of the future is completely rendered rendered useless. But typically we are paying for the growth companies or good companies, terrific companies, well discovered companies, some amount of price. So we should keep some amount of a margin of safety in those companies. And margin of safety is dependent on the price you have paid. It will be large at one price, and it will be much smaller at yet another price. And in sum, we say that to have a true investment, there must be a true margin of safety, because and it has to be by the numbers. It must demonstrate in numbers, because once the margin of safety is there, your capital which you have invested will remain safe. And on top of it, if your margin of safety is huge, you are guaranteed of very high return. And is the stock reasonably liquid? Because when you're buying large quantity, particularly for public money, I think this liquidity thing is important. But if you're buying small quantities, it doesn't really matter. In fact, illiquidity shows the ignorance of the market about the stock, or it is ignored, or it is not known to anybody, and hence it is one of the good starting point. I do look at what is the FI holding, what is the average stock of this thing, and in many times, if I'm convinced, I don't care too much about the liquidity, but still one must look at how it is trading, so that you would know how many days it will take for you to get in and get out of the stock. And then before saying let's go and buy, look at the risk involved in the stock which you are buying. And basically the risks are going to come. I mean, you invert, like Charlie Munger says, look at the reverse side of it. Basically, the risk is going to come from three sides: business risk, management risk, and valuation risk. So valuation, by having margin of safety, we have taken care. But business risk can be economic slowdown, adverse change in the competitive landscape, and adverse changes in regulatory framework. So you have to be bothered and think about them. And management risk can come, and we have seen so many of them: capital misallocation, and key man risk, and succession risk. So all these things you have to think through before you say that, okay, I'm fine with this, and then let's go ahead and buy the stock. So in conclusion, we have come to end of this entire presentation. And time is friend of good companies, enemy of bad companies. In 25 years, successful companies grow to unimaginable levels in sales, profits, and market cap. It is almost impossible to imagine what can be or what could have been the profit and sales of the companies 25 years back. Of the top 500 companies, only 100 companies have been able to beat the index in next 25 years. Stock returns are slaves of earnings powers and growth. In very long run, valuations matter less. The future always holds a lot more promise. Over 50% of the current market cap is made up of company listings before 1995. Every equity investing is complex. A checklist is an excellent tool to bring discipline to the process. 25 questions here and 25 related frameworks are a good starting point for an investor to arrive at their own checklist over a period of time. So this is what I have observations and